Hey, everybody, this is Brian Briscoe, the director of the Tribe of Titans and host of the Diary of an Apartment Investor podcast. Today, I want to answer one question that a lot of people have been asking recently. It's how does a capital raiser make money in an apartment syndication? Well, first of all, just asking that question puts me on a little bit of a slippery slope, and I'll explain why. When we talk about capital raisers, there's the idea that's perpetuated that somebody can just raise capital and bring that into a deal. However, that's not entirely the case. There are broker dealer laws in the country that make it so that you can't just be a broker. You can't just take money from one source and hand it to another source and get paid for it unless you have certain licenses, right? So inside the general partnership of the syndication, you have to be doing more than just raising capital. And just good tip is every time you get into a syndication, make sure you're getting the advice of a real estate attorney to ensure that you're compliant with the broker dealer laws. All right. Now, that said, let's assume that you're part of a GP where capital raising is one of your responsibilities. Now, let's look at how and when you make some money. All right. In a general syndication, the general partners are going to split certain incomes. A lot of the incomes are fee incomes, and some of the income comes just from a promote or carried equity in the property. And there's also the GP can also put their own capital in the deal as well. So first of all, the first place where most people are going to get paid is going to be at closing. And typically most syndicators are going to put an acquisition fee into the deal. So 1 to 3%, depending on the size of the deal. With smaller deals, typically, the fees closer to that 3%. As the deal gets larger and larger and larger, that the fee goes down. Let me backtrack a little bit. Every operating agreement is different. So generally, the GP members are going to split the income based on their percentage ownership or their percentage of GP shares. Okay. So it's just a pro rata across the board. If you have 20% of the GP, you get 20% of the income that comes to the GP. So, generally at close, there's this acquisition fee, 1 to 3% of the purchase price, and the capital raiser, so to speak, or the GP member that we're talking about will earn a certain percentage of that acquisition fee. Now, something else that happens, and this is while you operate the property, there's an asset management fee that's usually 1 to 2% of the gross income. All right. Now, if you're a capital raiser and you have other duties that do not include asset management, you're probably not going to get this fee. All right. However, once again, every syndication is set up based on what the lead sponsor wants to do. And this fee can be distributed to the entire GP pro rata, or it can go to the person who is doing the asset management. All right. Now, there's also cash flow during ownership. And it depends on, once again, how the deal is set up. If it's a straight split, AKA, 75% of all income goes to the limited partners, 25% of all income goes to the general partners, then 25% of all of the cash, all the distributions to the investors will go to the GP. And once again, as a GP member, you'll get a split or a certain percentage of the money that comes off of the property. Now, if there's a preferred return involved in this, you'll get a percentage that comes off the property above and beyond the preferred return to investors. And right now, I think the standard preferred return is usually about 8%, which means the investors will have to make over 8% before you get a penny from the property's cash flow. In a lot of cases, that doesn't happen. That 8% mark isn't met until the deal sells. Next thing we'll talk about is another set of fees. There are various transaction fees that can be built into the deal itself. So there could be a fee for a refinance. So if refinance is part of the business plan, the GPs could charge a fee to go through the refinance process. There could also be a fee at sale. Usually these fees are 1/2 to a full percent of the transaction price. I typically don't like to put these types of fees in because it doesn't necessarily align the interests between the GPs and the LPs. I mean, if the GPs are going to get a large fee for refinancing, and it may not be the best thing for the limited partners, interests are not aligned. But that aside, we'll talk about at the end, when you sell an asset, that's typically the next large piece of income that a GP member is going to get. In general, those are the main ways that any GP member is paid, capital raisers included, provided once again that they are doing more than just capital raising. So, real quickly to review, there's the acquisition fee right up front. There's an asset management fee that they can take part of. There's a property cash flow during ownership. There's various transaction fees that can be built in. And then there is the proceeds at sale, which typically the two largest events, two largest paydays that a GP member is going to get is the acquisition fee and the proceeds at sale. Now, let's make some assumptions while doing this so we can see some actual dollar amounts. All right, let's say it's a relatively small property, purchase price of $5 million, and bought it at 4 caps, so it has a gross annual income of roughly $400,000. All right, let's say you own 20% of the GP shares and that there's just a straight 75-25 split between the passive investors or the limited partnership and the general partnership. So if at closing the acquisition fee is 3%, 3% of 5 million is 150,000. All right, if you come in and you're 20% of the GP, you're going to get 20% of that $150,000, which is going to be $30,000 at close. Now, while the property is operating, let's say there's a 2% asset management fee, and we're just going to assume that, everybody's going to share, pro rata that asset management fee. So the gross annual income of 400,000, 2% of the gross rents, that's $8,000 to be shared among the GP. The cash flow during the ownership, this can vary. Typically we're seeing return to the investors, somewhere between 3 and 5% year one on the value adds. But making up some numbers, let's say that the property cash flows, $50,000 a year. In this case, it's a 75-25 split. If there's $50,000 a year that gets distributed, $12,500 is going to the GP, that's 25%. And then 20% will be going to you as the 20% GP member, which that's $2,500. All right. So between the cash flow off the property and the asset management fee, you're looking at about $4,000 a year off of a $5 million property. Now, at the end, if you have a transaction fee built in when you sell it, 1% of the sales price, if it's a $7 or $8 million sale, hopefully it's an $8 million sale, $80,000 gets distributed in addition to the GP share. Once again, I don't like putting that fee into any of the deals that I do. It's nice for us, but it just takes away from the investor. And I think personally that, the GP should earn the money, not through fees, but through the operations and through, buying something that has value. All right. So finally, let's say that the property is sold at $5 million, however long it takes. You return the member capital back, you pay off the loan, you got a couple million, $2.5 million, we'll say, to distribute. And at a 75-25 split, 75% of $2.5 million is, about 1.8 million. And then the GPs are going to share about 600,000. So if you're a 20% owner of that 600,000, you're making a low 6-figure payday. So all in all, what you get is 20% ownership, $30,000 in the acquisition fee, $1,600 a year from the asset management fee, maybe $2,500 a year in the cash flow coming off the property. We're going to round and call that 4,000 a year. If you hold the property for 5 years, 4,000 times 5 is 20,000. You're up to 150. And then if you just split that 600,000 between the GP, you're making about 120. So the answer is over 5 years, about $150 to $170,000, depending how well the property performs. Now you kind of look at that and break it down by year. What is that per year? $30,000 a year. One property is not going to make anybody rich. Now you string several of these deals together, and let's say you are GP on multiple deals every year. Maybe you're a GP member or 20% GP member on 4 or 5 deals per year. You can start stacking these things up, and that's a way to start making really good money. But once again, it's a windfall typically at acquisition, and it's a windfall on the back end typically at sale. And in between, there's just this little teeny trickle from the property cash flow and the asset management fee. Anyway, hope that answers questions. But how does a capital raiser make money in an apartment syndication? There's lots of different ways, lots of different levers, and ultimately, it's going to depend on what the lead sponsor puts into the operating agreement. And if you're coming in as a capital raiser, obviously you're going to have to perform other duties as well, but you need to be aware of what is in that agreement. So questions to ask: what's the acquisition fee? Am I going to take part in it? What's the asset management fee? Am I going to take part of it? And if you're not asset managing, probably not. What's the investors, the LPGP, split? What does that look like? Is there a preferred return in there? Is there a hurdle in there, and whatnot? What are the transaction fees and other fees that are in place? Anyway, that's it for today. And stick with us, because we're going to be dropping knowledge bombs like this all the time. Thanks. Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans, yet, you are missing out. So get yourself 30 days free by clicking the link below in the description, or go to thetribeoftitans.info, and we'll see you there.